Crazy about my money. Crazy about my money.
Notes to financial statements. Okay guys, as promised last time, we did our income statement and we did our balance sheet, which is the statement of financial position. So today we are going to focus on the notes. So the first note number 1, we call that interest income. Now this note, you'll find it on your income statement. Just gonna make sure that I do a small box here to show that this is a note, right? And just a column there to show the amount. So note number 1 is interest income. Under interest income, we have interest on fixed deposit, which is interest on fixed deposit. Remember, your fixed deposit, this is the money that you put in your bank for a period of more than a year, which is an investment. Therefore, the bank will pay you interest each and every year, and then now the amount, you will show it here. And then we also have interest on current account, interest on current account. So if you have money in your current account for some time, the bank will also pay you interest. So that is the reason why we call this note interest income, because this interest is an income, or the income we receive here, we take it from the interest that we have gained throughout a given period. Now the second note that you're going to find in your income statement is called interest expense. Interest expense. For sure you still remember, as we were doing our income statement, we touched on the income expense. Now income expense, these are the interest that the company pays or the business pay for the loan that the business took. So basically this is interest on loan. The amount, you're going to show it there in the column for amount, and the total you will show it there. This total is the one that you take to your income statement. These totals you take to your income statement. Same thing. All right, now we're going to move straight to the notes that you're going to find in your balance sheet, which is your statement for financial position. The first note that you're going to find there is note number, just put it up here, is note 3. So note 3, we call this note 3 tangible or fixed assets note. So on this note looks like this, right? So normally we have land and building, right? And then another item will be your vehicle, and we also have your equipment. These are just examples of all the tangible assets the business might have. So the note looks like this. All right, before I close it down, let me make sure that I show you the structure or the format. So the format looks like this. So number 1, we have carrying value. At the beginning, right? So carrying value at the beginning, then we have cost price or cost. This is also at the beginning. And we also have accumulated depreciation at the beginning. I'll just do that. Right. So just to make sure that everything is clear, just gonna do this just to show that this row falls under, or this row is for carrying value, and this row is gonna be for cost of sale, and this row will be for your accumulated depreciation at the beginning. Now, at the beginning, it simply means when the financial year begins. So normally when the financial year begins, or when you start your business, let me just start it there. What you will have is the cost price. You will buy land and building at a given amount, right? That amount, you will show it here. It is the cost of the land and building that you bought. Same applies to vehicle. When you buy any car or any form of vehicle, all the costs combined together, you'll put it there. Any equipment that you buy, the cost price, you'll put it there at the beginning when you start. So now what will happen is that we have a financial year. Throughout the years, land and building, vehicle and equipment, some of these assets lose value, which we call depreciation. This assets depreciate, loses value. Now, land and building, most of the time, it does not lose value unless something happens, which we will discuss, or you should be understanding this by now, but if you don't, we will discuss in the next coming topics for better understanding. However, a vehicle, for example, if you buy a car today for 100,000, by the end of the financial year, it won't be worth the same amount. It won't worth the same amount of 100,000. Probably it will be less than that. That's the reason why that's what we call a depreciation. It has depreciated. So let's just say throughout the years, vehicle has been depreciation. So accumulated depreciation, we just want to know how much depreciation did we accumulate throughout the years. By this we mean depreciation combined together for vehicle throughout the years to date. They amount to how much. Then that amount, we'll put it here. We show that this is the amount that we've been losing, or the value that we've been losing on vehicle as we've been using the vehicle. Equipment as well, same applies. We lost value. Total value, we put it here at the beginning. So now, what will happen now? Let's talk carrying value. How do we get to carrying value? I would like to start with vehicle. It's very simple. Carrying value, we just want to know the value of vehicle at the beginning. So at the beginning, we had the cost price when we first bought the vehicle, and then we lost value. For us to know how much the vehicle cost, how much is the carrying value of the vehicles in our business at the moment, we simply want to take the cost price, which is the amount that we have spent when we were buying this vehicle, and then we minus your depreciation, and then the difference, it will be our carrying value. So at this point is the carrying value at the beginning. So on this day, same applies to equipment. So on this day, today, if we choose that we want to sell vehicles, all the vehicles, we're going to use the carrying value. Let's say we bought this at 100,000, then we lost 10,000 throughout the years. Then if you want to sell the vehicle at the carrying value, we're going to simply say 100,000 minus 10,000. Therefore, we have 90,000. Therefore, we're going to sell our vehicle at 90,000, which is the value of the vehicle at the time. Same applies to equipment. Such will take place. So now, take into account that this is just the amount at the beginning when we start the year. So each and every year this is done, we want to know the value of the vehicle at a given period. Now, let's go to what happens throughout the years. Now, the next part from here, the following item is movement during the year. Movement during the year. So let me just underline this just to show that we are now tapping into what actually took place during the year. So what can happen during the year? Number one, we can have additional at cost. additional at cost. And then what is additional at cost? Additional at cost is simply if we choose to buy any of these assets, we will spend a certain amount. That item will cost us a certain amount. We should show that here, right? But I'll explain that a little bit later. Let me just continue with the structure. The following item from additional at cost, we can also have, during the year, we can have what we call disposal. Disposal at carrying value. At carrying value. Right, I'll also explain what is disposal at carrying value. And during the year, of course, we have what we call depreciation, which it should make sense. Depreciation is just the value that we have lost as we've been using the asset throughout the year. And then from there, we're going to have the following item. After the movement during the year, we're going to have carrying value at the end. Then we have cost price at the end, of course. Then we have accumulated depreciation at the end. So just to make sure that everything makes sense, I'll just make a row here for the additional at cost. Then I'm going to make another row here for disposal at carrying value. Then I'm going to make the last row here for depreciation. And then we're also going to make a simple row here for carrying value at the end, followed by a row, cost price at the end, a row again for accumulated depreciation at the end. All right, as we continue, let's focus on our movement during the year, additional at cost. Now, additional at cost, I would like to start with vehicle. Let's just say we buy another car or any form of vehicle in our business. We're going to show that there. Okay, we bought another car costing 50,000. Just going to show it there. Now, let's go straight to, let's say, equipment. We did not buy anything. We're just going to put a dash there. And then disposal at carrying value. Let's say we did not sell any vehicle. So disposal simply means selling. So we did not sell anything. And then equipment, we have sold one of our equipment, excuse me. We're going to show it there. I'm going to show it in brackets to show that one of our equipment went out. Right? We no longer have the equipment in our business. Now let's talk depreciation. Depreciation is the value that we have lost. Each and every asset, like I said, beside land and building, vehicle, equipment, furniture, and everything that we have as an asset loses value. So we are going to calculate a depreciation, and then this depreciation, to show that it's a loss of value, we're going to put it in bracket to show that it is a loss of value. So on how to calculate depreciation, we will tap into that when we do activities. Right now, I just want you guys to have a basic understanding on how to complete this note. Now let us move. Let's say we have bought a building. Okay, let me just leave a land and building for now. Let me just focus on these two items so we achieve a better understanding. We'll touch this at the end when we are about to close. So now let's go to, this is the movement that took place throughout the year. Are we together? This is actually what took place throughout the year. We have the beginning, we understand what's going on at the beginning, but then now during the year, these activities took place. Now let us focus on vehicle. Now we want to know the cost price at the end. What will happen is that we'll take the cost price at the beginning. Then we're going to add the cost price during the year. Are you with me? Cost price at the beginning plus additional cost during the year. Then this will give us the cost price at the end. Going back to our example, let's say our cost price at the beginning was 100,000, and we bought additional vehicle at 50,000. So it's 100,000 plus 50,000, which will give us 150,000 at the end of the financial year when we are closing, right? So that is how much we have spent on vehicle in total to date. Now we're gonna go to our accumulated depreciation. So we have accumulated depreciation at the beginning. We're gonna take the beginning and we add another depreciation that took place during the year, and then we're gonna have our accumulated depreciation at the end. So we put this in bracket because now this is the value we have lost throughout the year since we started running to date on vehicle. Now, how to get carrying value at the end? Very easy. Simply take your cost price at the end, you minus your accumulated depreciation at the end. This will give you your carrying value at the end. Now this, it is the value of our vehicle when we are closing our books at the end of the financial year. Going back to equipment. Now equipment, what happened is that we did not buy any additional equipment, right? But we have sold an equipment. So what will happen is that for us to get the cost price at the end, we will say, okay, we have the equipment at the beginning, then instead of us adding, instead we sold, then we will minus the cost price of the equipment that we have sold from the total equipment at the beginning. Then we're gonna say a certain amount, which is the cost price at the beginning, minus the disposal equipment or the equipment that we have sold, which will have the cost price at the end. Say for example, we have a total of 50,000 worth, or 50,000 as a cost price at the beginning, and then the equipment that we sold, we actually bought it at 10,000. So we're gonna simply say 50,000 minus 10,000, which will give us 40,000, which means the cost price will go down because we have sold an equipment. Now moving right away, the next part will be depreciation. Just to make sure that you understand, we're going to take accumulated at the beginning, then we add depreciation for equipment during the year, then this will give us the accumulated depreciation at the end. We put it in bracket because this is a loss of value. Then we're going to say the cost price at the end minus accumulated depreciation at the end. This will give us the carrying value at the end of the financial year. Now, before we close this part for note number 3, let us go straight to our land and building. So land and building is it's very, very simple. You can either add, which is buy, or you can sell part of the building or the land. So in the case of buying, just gonna add there. We don't put anything in bracket because we are adding more building or more land to the land that we already have. And then in a cost of disposal, let's say we sell the land, we're going to show it there. To show that we have sold the land, we're going to put it in bracket. Because of this, lower the amount of land and building or the value of land and building that we have. Then depreciation, like I said, land and building does not depreciate. Instead, it appreciates, which means it gain value all the time, most of the time actually. The only time the land and the building loses value is when something take place, which is a topic for another day, right? I don't want to bring it on because it will confuse the whole thing. Now, going back to the last part of the note number 3, cost price at the end. We're going to take the cost price in the beginning, we add the cost price during the year, then we minus the disposal during the year, then the total amount will have it here as the cost price at the end, which is simple mathematics. Do we have accumulated depreciation? No, there's nothing. Then we simply take the cost price. This will be our carrying value at the end. We can either sell this land and building at this amount or more to make profit. Now, the amount that you are going to take to your balance sheet or your financial statement is the carrying value at the end. However, you need to ensure that you add the carrying value for equipment plus carrying value for vehicle plus land and building carrying value, 1, 2, 3. You add them together. Land and building plus vehicle plus equipment. This is equals to the total amount of tangible asset. This you take straight to your balance sheet. Then that is the end of note number 3. The next item, as we are focusing on our note, is note number 4, which is inventory. Note number 4. Note number 4 also falls under statement of financial position. Inventory. I'm going to just leave a column there. This column is for the amount. So under inventory we have the following items, which is trading stock. Trading stock. So trading stock, this is the value of stock that we have. So at the end of the financial year we do a stock count. We're counting how many stock do we have on hand in the building. So that value of the stock, we're going to put it there. The next item that we have also under inventory is consumable stores on hand. Consumable stores also on hand. So we're going to simply count our consumable stores, how much do we have in the building, and then we're going to put it there. Now you add the two, total amount. This is the amount you take to your balance sheet statement, or the statement of financial position. Very nice. Moving right along, note number 5. Note number 5 is trade and other receivables. Trade and other receivables. I'm going to just do a small column there just for the amount. I'm going to put R there to show that this is amount. Good. So under trade and other receivable, the first item is net trade debtor. Net trade debtors. Net trade debtor is made out of trade debtors. Trade debtors. What are trade debtors? This is amount you take it from your debtors control account. You put it there. And then now followed by provision for bad debts. Provision for bad debts. Provision for bad debts. So provision for bad debts, normally it is the amount that we expect to lose when it comes to our debtors. So we're going to put it in bracket. So this will decrease the amount of the trade debtors, or the amount that our debtors owes us. Then we're going to simply say, we're going to put this in the box. We're going to simply say trade debtor minus provision for bad debts, which will give us the net trade debtors. Now the next item from that falls under trade and other receivables, we have income received. Income receivable or accrued income. Accrued income also falls under trade and other receivable. This is the income that is receivable. Let's say, for example, we are renting out part of our building or part of our land. So each and every month we expect to receive a certain amount of money. Then the financial year ends, but then we did not receive the money yet. So that amount is accrued. It is received. So the next item will be prepaid expense. Prepaid expense. Prepaid expense, let's just say we have advertising. Advertising, we pay advertising each and every month. It is an expense, right? But then what happens now when we pay this advertising or advertising company in advance? We pay it before time. We expect the same value of advertisement to be received to the business. I don't know if I make sense. So if I pay an amount of 100 Rand in advance to an advertiser, which means I expect to receive a 100 rand value of advertisement in the near future. So therefore it is receivable. That amount, I'm going to show it there. The same as accrued income, it is receivable. I'm going to show that amount there. Now our trade and other receivable, it is made out of net trade debtor plus accrued income plus prepaid expense. So when you add all these items will give you a total trade and other receivables. Now this amount is the one that you take straight to your balance sheet statement or the statement of financial position. Good. The next item now, without a waste of time, it is note number 6. Note 6. This is cash and cash equivalent. Cash and cash equivalents. So I'm just gonna draw a table there. I'm gonna do a column there for an amount. Shouldn't be that big, but I'm just gonna do my thing. Note number 6, cash and cash equivalents. So on cash and cash equivalent, we are focused on cash items. Where at this moment we have fixed deposit. Fixed deposit. What kind of fixed deposit is this? It is maturing within or matures or maturing within 12 months. So a fixed deposit, remember, is an investment, but then now if it matures within 12 months, this amount will be accessible within 12 months. Then it falls under cash. We can access it. It falls under cash and cash equivalent. The next item is bank. The money that you have in the bank, it is also accessible. So it's cash. It falls under cash and cash equivalent. We also have what we call savings account. That amount in your savings account can also be accessible anytime. So financial position. Now the next item will be capital, which is note number 7. Note number 7, we have capital. As we learn about capital all the time, capital is money to start the business. So capital, I'm going to do the same thing. This is note number 7. We have the column there for amount, just to make it easy. So the first item, we have balance at the beginning of the year. Balance at the beginning of the year. So each and every year, we will, of course, our capital account will have some money or might not have some money. But then in the case of capital, most of the time in a business that is functioning, it has a positive amount. Therefore, we're going to show it there, the opening balance. Then what can happen during the year? Right, note number 7, capital, as we continue. So we have balance at the beginning, we show it there, the beginning of the year. So during the year, we can have contribution of capital, contribution of capital during the year. So it's possible that the owner or owners during the year, that they can contribute capital. So the amount that they contribute, you're going to show it under in the column for the amount. And then another thing that can happen during the year is that we can have withdrawal of capital. During the year. So So what can happen is that the owners can decide that they want to take portion of their capital, withdraw a portion of their capital for whether personal use or whatever reason. So we're going to show it there in a bracket to show that the amount goes out, right? And then the last part will be balance at the end of the year. So what will happen here is basically, here are the calculations. We have balance at the beginning plus contribution for the year, and then we minus withdrawals of capital during the year, and then we will have the balance at the end. Simple, easy, in and out. Now the other note, we have note number 8. So note number 8, we will deal with it separately because we have current account as note number 8. This is grade 11. Grade 11 work basically is partnership. So in a partnership agreement, we have what we call a current account as note number 8. Now we also have note number 8 for grade 12, which is retained income. Retained income, which is grade 12 work. This is companies. So this is grade 12 work. I'm gonna make a video separate for these two notes for a better understanding so that you don't confuse the two. So if you're doing balance sheet statement for partnership, you will have what we call current account as note number 8. And then if you're doing note number 8, if you're doing note number 8 for grade 12 or for companies, that will be retained income. We will deal with this in the next video. NEXT, next video. Please stay tuned when I explain that. Note number 9, it's very easy to complete. We call it a note number 9. This is trade and other payables. So under trade and other payables, I'm going to just make a column there for the amount. These are payables. So we have trade creditor, this we take from our creditors control. Creditors, these are our suppliers, the suppliers that allow us to buy on credit from them. So we are going to pay them at the later stage. So they supply us with stock, then we pay them at the later stage. Those are trade creditors or creditors. So therefore the amount owed to them, it is payable, which still needs to be paid. And another item that still can fall under trade and other payables is expense payable, which is accrued expense. Accrued expense. Accrued expense. These are expense basically that still need to be paid. Let's say we are behind with water and electricity we have been paid for the previous month or for the month before the financial year end. We're going to show that amount there under trade and other payables because that amount is payable. Also, income received in advance. Income received in advance. Income received in advance is whereby a client come to us and pay us money for a certain service that we need to offer, and then we are promising that we will offer the service the next coming few months after the financial year end. This client basically paid in advance, so we owe the client a value of that amount that this client has paid. Therefore, that falls under trade and other payables because we still need to offer that service amounted to that value. Now, our trade and other payable will be made out of trade creditors, accrued expenses, and income received in advance. All that form part of trade and other payables. Now, this amount is the one that you'll take straight to the balance sheet or statement of financial position, whichever way you want to call it. Either you call it a balance sheet or statement of financial position, it is the same thing. Now our note will end here. In terms of grade 10, when it comes to note number 8, we do not have note number 8 under grade 10 content. Therefore, automatically your note number 9 will be your note number 8, which is trade and other payables. Now, please make sure that you hit that like button and you subscribe so that you get notification every time we post a video. Thank you so much. Let us go and prepare for our final examination, and join me next time when we do activities based on this introduction videos to all the financial statements. Thank you so much.